Are you thinking of building wealth for your future? Most people in India think of real estate, gold, or equity investment. But what if we told you there's a smarter and simpler way called virtual estate creation? Let's understand what it is and how it can benefit your future goals. In India, people try to create wealth by buying real estate, gold, or investing in equity and debt instrument. The purpose? To sell this asset during retirement or ensure their transfer to family members after death. People buy property mainly for three reasons: as a necessity for shelter, for rental income, for future needs and life goals like marriage, education, or retirement. Most of us invest in real estate to secure our future goals like funding our daughter's marriage, paying for higher education, upgrading to a bigger home, building a retirement corpus, handling medical emergencies, or recovering from business losses. It's seen as a long-term safety net. But investing in property is not always smooth. Here are some real challenges. Returns are often single digit, not enough to beat inflation. There is a fear of job loss affecting loan repayment. High taxation eats into profits. Home loan interest rates remain on the higher side. 100% loans are not available, so you need to arrange margin money. After demonetization, black money can't be used for quick deals. And under construction projects are often delayed or stuck. When you really need funds, selling real estate becomes difficult. It takes time to find a buyer, sometimes months. There is emotional attachment, making it hard to sell. You may need approval from family members. The market may not support a good price at the time. Plus, legal and tax issues slow down the sale process. But what if you could plan smartly without these problems? That's where virtual estate comes in. Created through insurance. You pay small premiums and build an estate over time. Estate planning through real estate. We create a physical estate by paying home loans EMIs. In case of our absence, the property is passed on to family. If we are present, once the loan is cleared, we can sell the property fully or partially to meet future financial needs. Estate planning through insurance, virtual estate. We build a virtual estate by paying small, regular premiums. On date, the sum assured is directly transferred to the nominee. If we survive the term, we receive a matured amount, a guaranteed estate value, tax-free and hassle-free. Let's compare real estate with virtual estate and see how virtual estate wins in every way. First, higher value for money. In virtual estate, if you pay 10,000 rupees as a premium, you can get a sum assured of around 20 lakh rupees. In real estate, the same 10,000 rupees EMI can get you a home loan of around 13 lakh rupees. This means you can purchase a property worth 13 lakhs only. So, with the same outflow, you get a higher purchase value in virtual estate. Second, guaranteed value. In real estate, after 20 years, your 13 lakhs rupees property may or may not become 39 lakhs rupees. The appreciation is not guaranteed. In virtual estate, your 20 lakh rupees sum assured can grow to a guaranteed matured value of around 40 lakh rupees. This means guaranteed wealth creation, which give you more confidence and security. No tax deduction on returns. In virtual estate, the maturity amount is completely tax-free under Section 1010D of the Income Tax Act. In real estate, when you sell the property, you must pay capital gain tax. To save tax, you need to reinvest or buy capital gain bonds, which adds complication. No need to find a buyer. In virtual estate, once your policy matures, the money is credited directly to your bank account. In real estate, you must search for a buyer, negotiate prices, and deal with delays or cancellations. Often, at the time of need, you don't get the right buyer or the expected price. Flexible EMI handling. In virtual estate, if you face financial issues, the plan can be adjusted or revived later. In real estate, if you stop EMI, the bank can seize the property and you lose both the asset and the investment. Pre-approved loan facility. In virtual estate, after 2 years, you can get a loan against the policy without showing income documents. In real estate, to get a a home loan or top-up loan, you need to submit multiple documents, income proof, and go through lengthy process. EMI discount options. Example, in LIC's Jeevan Labh plan, you pay premium for 15 years and get coverage for 21 years. This gives you a 6-year EMI holiday, which means more savings and better returns. Smooth nominee transfer with no disputes. In virtual estate, on the policyholder's date, the sum assured is automatically transferred to the nominee. Multiple nominees can be added and the nomination is beneficial in nature, meaning it cannot be disputed. In real estate, after that, there can be family disputes, legal claims, and lengthy property transfer process. Fixed EMI throughout the term. In virtual estate, your premium remains fixed for the entire duration of the plan. In real estate, home loans EMI keeps changing due to fluctuating interest rates, making budgeting difficult. No maintenance cost. Virtual estate has zero monthly maintenance expenses. In real estate, you need to pay monthly maintenance, which increase every year. In some societies, these costs are very high. No extra charges. In virtual estate, you don't pay stamp duty, registration, or brokerage fees. In real estate, these charges can add up to 8% to 15% of the property cost, a big outflow in the initial stage. No legal disputes, litigation risk. Virtual estate plans are managed by reputed insurance company and government by IRDAI. No scope to disputes. In real estate, there could be litigation, ownership issues, or builder-related disputes that can trap your investment. No risk of property acquisitions by government. In real estate, your land or property can be acquired by the government for public development, roads, railway, or industrial projects. Virtual estate has no such risk as it is not a physical asset. Natural disaster-proof investment. Real estate can be damaged by floods, earthquakes, or tsunamis, leading to massive losses. In virtual estate, your investment is safe and unaffected by natural calamities. Guaranteed maturity with 100% capital protection. In real estate, under construction, properties may get delayed or never completed. Plus, no capital protection. In virtual estate, there's zero delay and your capital is 100% guaranteed by the government of India, especially in plans by LIC. So friends, real estate may look attractive, but virtual estate is smarter, safer, and stress-free. It helps you plan for life goals, protect your family, and get guaranteed returns without the usual problems of property. If you found this video helpful, do like, share, and subscribe to our channel. For more tips on smarter financial planning and estate creation, contact us immediately. Thank you.